As we begin trading on any day, we already know approximately where the market is going to open because we look at the overnight trade and we can see what the last trade is overnight as we come up to the opening time for the NYSE. Before we start to actually replay the first, we know that the market is going to gap lower. Going to gap lower immediately gets us to focus on what is beneath the expected opening. Beneath the expected opening is the 2800 level. The 2800 level has served as a support level for some time for the E-mini S&Ps. We've been below it, we've been above it, but generally around that area, the market has found support. So that's one of the things we'll be focusing on this morning. After the market opens, if the market finds substantial support at or above the 2800 level, then we got a pretty good chance we're going higher. If the market finds easy acceptance below that level, then we've got a start of a new leg to the downside. You notice on 7:30, it was a poor low, meaning there was no single prints on the low. The market had traded higher, but we always carry that information forward. So at this time, let's get ready to replay August 2nd, and we will then monitor and narrate this day as the day goes on. All right, the opening takes place below the 2800 level, and that's a level we said we will be paying a lot of attention to. When it opens, the poor low from 7:30 has been corrected. Once we trade through a poor reference, then it has been repaired and we put it off the books. It's no longer counted. All right, so now the market is trading down lower. When you get a gap like this, particularly a gap of this size, it's not uncommon to have trading come in immediately. Just people have a tendency to follow price and just, jump on it. So right now we traded lower. The opening is always a short-term reference. If the market is really weak, we probably don't come back to the opening. Trade back through the opening, we got an indication that the market's not that clear on what it's going to do. Now, the next reference above the opening is the very visible low from 7:30. Markets are always focusing on references that are visual. It's the easiest thing for short-term traders to do, and you'll see that it's something that's very, very common, and it will help you have an appreciation for what the people you are competing against are doing. The low is not too far from the opening. The high in A period is a single tick below the low of 7:30. So it is a weak low because it's within a single tick of a very visual level.
Correction, a weak high.
I'm sorry, it's a weak high. All right, so the chances of coming back through that high are very good. Does it have to be that way? No, but the chances of it coming back through there are very good. And this is the importance of being able to take in a lot of information and not get mesmerized by the big gap down and by price jumping all over the place. It's what we call chunking, being able to take the information in fairly calmly and not get yourself very emotionally wound up. Okay, so one more time, we've come back. Now we're back exactly at the low from the 30th. We said there was a pretty good odds that the market would come back to that level. It's a good piece of information because it helps you from getting caught on the short side. Sometimes you wish you hadn't paid attention to it, but more often than not, you'll find it's a very meaningful piece of information. So as we continue on through A period, The market has re-entered that range just below the 2,800 level. The high we've got so far this morning looks to me like it'd be about 27.9850. So, we're a handle and a half below the 2,800 level. So the 2,800 level is still a reference that we are paying attention to. Now, it's not a visual reference like the low from the 30th, but it is certainly a reference that every short-term trader knows. Even numbers 2,800, 2,850, those are always levels that are very front and center for short-term traders. And it doesn't mean that, longer-term traders aren't looking at that level, but it's just more of a short-term trader's reference. All right, so as A period continues, the market is still unsure of itself. We have been back and forth through the opening several times. What is important when it's not that clear what the direction is once the gap was there is for you to just sit back and relax. Too many times when you've got this volatility, traders are jumping all over the place, so afraid they're going to miss the day's biggest trade. Some will go long, some will go short, and that is usually a pretty disastrous way to start the day. Not only do you spend financial capital, but you also can spend a great deal of psychological capital. I contend that psychological capital is actually more important than fundamental capital. All right, one more time, we're back through the opening. We're looking one more time at the 2,800 level. We're looking at 27.9950. Now we're right at the 2,800 level. So you can see we talked earlier, said that's a very logical place for the market to go. The high right now is weak, and the reason it's weak, it is exactly at 2,800. Being it's a weak high, it's a very visual reference, and it is something that the odds of coming back through that high are very good. There'll be some traders that can't wait. They're so excited they automatically sell short at the 2,800 level. They go, oh boy, that's the number I was looking for. When the number is that easy and it's at an exact level, the chances are that is not going to be a lasting high. That is another piece of information. It's very important to take in and think about. So when the days with all this emotion come around, you have already vicariously lived through some of those days. It will give you a tremendous advantage. It'll allow you to keep your psychological level at a better keel. And you always get excited when the markets are down here, but it will allow you to have better control. Okay, we're now trading above the 2,800 level. Remember we said when it sold off from 2,800, the chances were real good we'd come back to that level. And you notice that it did. So if you're a short-term trader and you're looking to do some short-term trades, when the market looks below 2,800, stopping exactly there and backing off, you may want to take a short-term long at that position. That is a very legitimate trade for a short-term trader. You have a high that you don't think is any good. You have a very visual level. It's also a psychological level. So you get that poor high, a weak high, the market trades below it. It's a legitimate place to attempt a short-term buy. All right, so the market's continuing higher. What speed are we playing at, Jen?
We are playing at 2x speed,
Okay,
and we're 13 minutes in.
Okay, so we're about halfway through the first half hour. Let's pick it up to 5 times. So we're just going to watch this play out. Right now, we have an excess low. The excess low, it's a single prints. Now, we don't know what will happen when the second period comes along. B period may come along and take out some of those single prints. We don't know that. But right now, we have an excess low. There is also excess above today's high, that area in the gap between the previous day's low and today's high. We're also going to consider that to be excess. remember, I took it from the low, not from the settle. Okay, so the market back and forth through the 2800 level, back down near that early morning low that we saw at the 30th, at the 2730 level. We went right down to about half back, just above the opening. Market's trading back up again. A lot of chop going on in here this morning. When a market opens down, this much, and we had a big gap, you can understand the emotions are running very high. When emotions are running high, you've got some traders that can't wait to sell it, some traders that can't wait to buy it. Right now, we have an excess low. Okay, the market traded back off. It came back up, so it's very common when you put a low and rally, very common to come back at least once and check that level out. We traded above 2800, we came back and we went down one more time and checked it out. Now we came back through the 2800 level with a little more authority. Now we're looking at a lot of single prints from the low up to where the current trade is taking place. It would be unusual, not impossible, it would be unusual for all of those single prints to be taken out. The chances are very high right now that we have the daily low put in. You said, well, that's how can you make that assessment so early, Jim? Well, the market was under a lot of pressure, sold off very hard. And it tried it down there a couple times and you didn't get the follow through. So my guess is that, they got themselves probably too short and now the market leaving an excess low and it's trading higher. It's just an observation from experience. Does it have to be that way? No, it doesn't. It's just something that when I look at it, I see it as a pretty good chance. And quite honestly, there's another thing that the odds are very, very high that the low or high for any day is made within the first 90 minutes to 2 hours for the day. I mean, I don't know how high it is. I haven't actually measured, but I would guess it's 75, 80% that the high or low for the day is made early on in the session. All right, so we're changing time periods. We have 2 ticks excess on the high. Now we have no excess on the high, so it's a poor high. The upside reference, short-term reference right now, is going to be the low from 8-1. It's the low from the previous day. It's very visual. It's very obvious. If there is to be any real meaningful follow-through relative to what we've seen on the morning of 8-2, we will find acceptance back within the range from 8-1. We will then move higher and get through unchanged. Unchanged is where the red line is and the kind of green circle around it. So that would be if we get accepted back into yesterday's range, the next upside reference would be the unchanged level from the first. Okay, we're in the second period, we're trading higher. Okay, so there's, we're continuing up into the range from the first. And now, as we said earlier, pretty good chance that we have an excess low today. A lot of single prints down there. In fact, it may even be too many. I don't know. That's an awful lot of single prints for, the emotion that we had in here this morning. All right, so now we're in the previous day's range. We have not really had acceptance within the previous day's range so far. Acceptance takes place when the market either really, speedily moves away from the low, or we start to get double prints for, let's say, too wide. We're trading in there for the second period. How much time do we have left in B period?
20 minutes.
Okay, so B period's got a long way to go. We've just started B period. The market is in the previous day's range. We've got a lot of volatility. And now we just let the market play out at this point. I do think that your trade was long when we traded above the 2800 level. Looked stopped right there, backed off, and then I think that was a long trade. Now, they'll scare you because the market came back down and traded below the 2,800 level again. And that'll scare the daylights out of you, and you lose confidence. Sometimes you just have to give the market some room, and you have to take a little heat if you think you have good reasons for having that trade on. And as long as you have pretty good excess on the day, it's legitimate to continue to hold that position. If that lower excess starts to get eaten away, now you want to come out of that trade and give it another thought. But so many times traders are too tight in how they manage these stops. The higher the volatility, and the volatility certainly picked up on this day, the wider you're going to have to make your stops. The stops you might use on a very narrow day are one thing. So stops you use on a high volatility day have to be much wider. You have to be more lenient with them. If not, you'll get stopped out several times, and you'll find out that where you thought you were taking less risk, you were also taking more risk. So again, it's something you have to take into account. As the volatility on a particular day picks up, your stops need to be widened out. All right, so we're back well within the range from the previous day, well above the 2,800 level, and the market is looking at, you can see that reference. We said the unchanged level is going to be the next level. It's easy to see. Every trader, every short-term trader knows where unchanged is. If you don't know where unchanged is, you have to rethink your trading, because it's just a short-term trader's reference. The previous day's high and low, the settle from the day before, or the unchanged level, those are all really important references to short-term traders. I mean, they're not going to give you the edge necessarily, but they certainly help you keep some perspective of what is really going on in a market. So you can see the market well back within the range from the first. Good single prints on the low, which is a form of excess. And remember, excess and balance are the two most important concepts that we look at. Another way to look at balance may say, when we look below the 2,800 level this morning, that was the market's attempt to come out of balance. Of course, that was the low for several days, and you can say the market failed to come out of balance. Market tries to get out of balance and fails, that's usually a buying opportunity. So one more time, you see the market trading up, and you see it tick or two below unchanged. So that is a very questionable short-term high in here. And those are things that you have to be able to see and recognize immediately. If you don't see those things, you don't see where the low was, you don't see where the 2,800 level, the poor low from 730, those things you should see immediately. And that all falls under the category we call chunking. Chunking is just a term that describes things you do in a very routine manner. Walking down the stairs in the morning, backing your car out of the garage. Those are all a result of chunking. You've just gained that information, you've internalized it, it's become intuitive to you. There's a lot of things in trading that you have to be able to take in very quickly. When you're backing your car out in the garage, you have to see a lot of things all at one time, almost automatically. And it's the same thing with trading. All right, the high on the second is a weak high because it is a single tick below unchanged from the first. That is a very significant reference. A lot of times when I see that, if I wanted to get long and I wasn't long already, I'll buy the first pullback because I think the odds are so much in my favor that we will come back through and take that high out. Now, once it takes the high out and it gets above unchanged from the previous session, well, then we have to make a new assessment. Remember, this is a continuous two-way auction market. We auction from low to high and from high to low on a continuous basis. Some days the market will one time frame higher or lower, so you don't get a lot of rotation. So far today, we are auctioning higher. Okay, and you see now we're back we're back to and through the unchanged level. One more time, see the value of those references. Now the next reference here is the green line just above the C period high. That green line is the point of control from the first. Remember, another word for point of control or phrase is the fairest price at which business is being conducted. So we now came back up to just a couple ticks below the fairest price for business on the first, or the point of control. The point of control is also something a lot of traders know and reference. You don't have to be a profile trader to know that. Traders that are not profile traders just intuitively know where the markets found a good deal of trade on the previous day. I had a membership on the floor of the Board of Trade, as well as the options exchange, the CBOE, and those are just things that floor traders know. All right. So again, the high in this case isn't as questionable as the high we had just short of unchanged from the previous session. This left us a couple of ticks, and you can see the market backed off from that level. Now this is the type of thing that makes it very difficult to trade. If I had bought the market when it backed off from unchanged and then rallied up to the point of control or just below it, I probably would have exited that trade the minute it traded back down below the point of control, because then I don't know what I'm dealing with, and I have a little more question about the longevity of that trade. So now they're making it very tough. If you look at the white line just below the A period high, that is the halfway mark for today. Halfway mark is also a reference that we continually look at. So we're seeing single prints now from the point of control up through the low from the previous day. So we're getting more volatility. We've got a couple of distributions, the lower one, we've got single prints, and now we have this upper distribution. A lot of volatility, a very difficult and emotional day to trade. Okay, so one more time, we're back down towards the low from the first. Not an easy day. The big pieces of information I see, we do have an excess low. We have single prints on the low, and they go for quite a range. If you can take a look at those, Jen, from the low, how many single prints we have from the low up to where we're currently trading. And you can see, I'm not going to count them, but you can see they're substantial. And you know, it would be okay to take some of those out, because that's a lot of excess. But it would be unlikely we'd go all the way back down and take them. We could, but it would be a low probability. So we're in there. We probably have an excess low today. I said earlier, probably very good high that the low for the day is put in. But you know, if you're long and short-term trades, there's a lot of room to get whipsawed in here. That's quite a range in C period. The C period range is from, you know, approximately 2804 up to, what's the high on the C period range, Jen?
2812.50.
Okay, and so that's about an eight handle range for C period. That's a lot of range.
7 3/4.
So we've got a lot of volatility on the first. They're not making it easy for us. The low still looks good. We've come back down right around the low from the first. The market did not trade and yet follow through and acceptance again back down below it. We looked below it, but the market got kicked out of there again. So now we're back above the low from the previous day. we're into D period, and the market's still one time framing higher. So A period low was not taken out. The B period low was not taken out by C period. So far, the market's still one time framing higher. Even though we've had all this volatility, you want to pay attention. You want to pay attention to the one time framing. One time framing is a very powerful concept. It really helps me understand sometimes, in what direction is the market proceeding. So you see C period once again down there testing and challenging the low from 8.1. Value is building its overlapping to lower at this point. You can see the blue area from the first. That is the value area. The developing value area is the blue range on the second. So again, they're helpful references, but this is a difficult day. We are still one time framing higher. D period is a fairly narrow range. How long have we been in D period, Jen?
Almost 10 minutes, about 10
Okay.
minutes.
So we're about a third through the half-hour period. D period doesn't quite know what to do. It's looking higher, it's looking lower. They keep pushing on the downside, keep pushing towards the low from the first. Now the low from the first, every trader knows where that is. So it's a very common thing for them to, be trying to do. Okay, they tried to get down there. They stopped just short of that low, and you see buyers came in and the market is one more time trading higher. But so far, D period is an inside bar relative to C period. Inside bar means neither the high nor the low traded outside of the high or the low of the previous period. If a market spends it the entire time within this half hour, within the range from the previous period, then we say we have short-term balance. Remember, excess and balance, the two most important concepts we deal with. So we have an excess low today. We have an excess high. The excess low is better. The high is not quite as secure, I don't think, because it's just a couple of ticks away from the half back level from the previous session, very visual level. All right, so the market is, we tried the low one more time, and now the market's coming back to the upside. Remember, it's a continuous two-way auction process. It's very helpful to continually remember and remind yourself that it is a continuous two-way auction process. That will help you have a better understanding and appreciation what is really going on in the marketplace. The reason that the continuous two-way auction process is so important is evident here. You've got bids and offers coming from all over the world, and particularly on a day like this where the market gaps lower. So the emotions are high. And when the emotions are high, the best way to handle these, bids and offers with many different opinions coming in is through an auction process. So nobody has to sit there and allocate, you got this and you got this. We let the market decide what is fair. All right, so now D period trading back up towards the C period high. Remember earlier on, we commented that we thought the C period high might be questionable just because it was so relatively close to the point of control from the previous day. Remember, another way for the previous day, it's the highest volume area where fairest price, highest volume area, where price was being accepted. So thinking of the fairest price is an extremely important concept. So now we do not have any excess on the high. We have excess on the low, not on the high. D period is still within the C period range. Traders got up when D period got up within a tick of the C period high. There's some traders that just automatically sold it there. You'll have two things take place. You'll have some traders that are long that'll automatically take profits there. You'll have other traders that will automatically short it because it's such an exacting place to short. They can see it. They know exactly where they want to put their trade on. And usually that is not a particularly good short. When they do things for, reasons like this, they're usually not very good. Okay, D period was an inside bar to C period. So that was the market came into short-term balance. E period is back up and has matched the C period high. And the market is still just shy of the point of control or the fairest price at which business was being conducted on the first. So we have no excess on the high today. We have substantial excess on the low. Can we review the excess on the low one more time? So you see substantial excess on the low, no excess on the high. The odds are very high that this market will work itself higher for the remainder of the day. It doesn't have to, of course, but trading is about odds. It's about being able to think in terms of odds. And as we look at this, what I'm trying to walk you to is just the odds. And you can see, okay, we did come back. D period was an inside bar, gave the market short-term balance. And we came out of D period and we've moved higher. We're still one time framing higher. The next reference is the kind of reddish line, pinkish reddish line on the left from the previous day's profile. That is the half back level from the previous day. Half back levels are another level that short-term traders are very familiar with, whether it's halfway back on the overnight, halfway back on the day time frame, relative to the next day. It's a very easy reference for them to look at and reference. So we see that the market is still one time framing higher. We have moved higher into yesterday's value area. We're above the settle, or just short of the half back for the day, but we're well above the half back level for the value area. The half back level for the value area will be approximately where the point of control of the green line is. All right, so the market's pretty active. Let's speed it up a little bit more, please.
Is 10 speed okay?
Yes. Okay. Now we're going to play this out pretty fast because there's just a lot of things I wanted you to see early. You saw them. What I hope you also did was feel the emotion. Now it's hard to feel the emotion I'm talking about unless you were part of that day, you had a trade on, or you were waiting to do a trade. When you get involved in the market, all of a sudden you get a much better idea of volatility and the emotion that I'm talking about. It always looks easy to do from a distance. I can promise you, once you make it live, it's very different. And this is why I don't have any problem with paper trading till you get your feet wet, till you get some idea. But I wouldn't do it very long because you'll start to lose track, and you'll think it's too easy. You'll lose track of the psychological factors. All right, so we're still one time framing higher. We have traded above half back from the first. We haven't found acceptance there yet, but we are still grinding our way higher. Now the market's getting pretty spread out. It's getting very thin, and we've got, look on the low. I think we've got a small distribution on the low. Then that's separated by a couple single prints. Now we have middle distribution, and now we have a market one more time looking at the CD period high, and we're keeping ourselves away from that. So we're spaced above it now. Now, the other important thing, what happened at the 2800 level? Remember, the 2800 level, we looked below it, we came back to it, we looked a little bit at it, a little bit lower again, came back above it. So you've got to put into your mind that the 2800 level, once again, served as support. Now, you're going to get all different kinds of opinions in here. And you're going to have some people that want to go short because, boy, they saw that price go lower this morning and they're just bound and determined they're going to sell every rally. You got other people that are covering shorts, and then you got other people that, like me, that may say, I want to buy here. I want to buy that market. So there's the different motivations are huge. And again, that is best handled through an auction system, a two-way continuous auction system. All right, so let's take a look near, so we look at the upper portion of yesterday's profile, or I mean the profile from the first, and you can see it's fairly thin on the top. There was a double distribution. If you look at the single E prints, that was a double distribution. Anything below that formed a new distribution. Anytime you close a previous distribution, you have to pay attention because that is usually an indication that change is continuing relative to the previous session. Okay, one time framing continues. The market still is very spread out, very thin, which makes me very cautious. But one of the things that is happening here, this kind of spread out day that we're seeing is coming from a major reference just below the 2800 level, or right at the 2800 level. Having a market profile spread out this thin and this many distributions is different when you're coming from a major reference than it is if you're coming from just a kind of lackluster day the day before. Okay, so you can see the shorts that were in the part of that gap, the shorts that traded early this morning are getting caught in the market. Okay, so we've gotten very thin here. We're in F period. So, and how much time do we have left in F period?
Only 3 minutes.
How many?
3 minutes?
Okay, so we're almost done with another period. And you see the market is really starting to move to the upside. What's happening here, those shorts that, gapped the market lower and sold the market early, they're getting caught in here. Remember the dispersion model? You have the innovator, the early adopter, early majority, late majority, and laggard. Laggards can work two ways. You can have, if the market's going down, you can have laggard sellers. But also, when the market got short overnight from the gap, you can have laggard short covers. And I think that's what we're looking at this morning. This market's up so much and thin. I think we've got short covering, and I think some of it's the laggard short covers that just couldn't, they didn't cover, and now they're throwing in the towel. You also probably had new shorts that sold just chasing the gap to the bottom this morning. Okay, now so you can see that market's pretty thin, it's continuing higher. We've got several highs around here that are very close. We've got the C period high, the F period high, we've got the A period high. You see those from 730, 731, and 81. So you see those highs, kind of bunch those together and you say, okay, that's a logical reference for selling to come in because that's where the market stopped. In the last few times it's tried to go up there. And if it stopped there, remember, traders do what works until it doesn't work anymore. So those that have been shorting around that level, they'll probably try it again here. And of course, one of the times they do that, it doesn't work. The more they try it, the greater the odds are that they're going to get, pushed back quite a bit. Okay, so we're still approaching the high from the previous day. So we do not have an outside day. An outside day occurs when you look below the previous day and then you trade above the previous day's high. Technicians like to think that's a big deal. I don't think it's necessarily a big deal, but it's certainly something I pay attention to. If it really is meaningful, I want to see the market really pick up some legs above that high from the previous day. That's just a more confirmation to me than there's either big shorts or there's new money coming in. Okay, how many minutes left in G period?
About 15 minutes.
Okay, so we're halfway through G period. We had a lot of single prints. We've gone down and filled in some of them. The market, of course, is going to be looking at the high from the first, or the high from the day before the day we're trading. Notice while we're looking at this, notice the high on 731. The high on 731 was poor. The market did come back on the first, take out that high. And then once the high was taken out, then they became sellers. Okay, so we've changed time periods once again. The market is still very thin and is still looking very much at trading up to and through the high on the first. Now, when I see a market stretched out as much as this is, all the single prints and the lower distribution, you have just 3 or 4, all the single prints above the E period high, I get very uncomfortable and I start to think the market is so spread out. I think the risk of being long in the market is exceptionally high. And when I see that and I make that observation, then I do a couple things. Either I sell my longs, I reduce my holdings in the longs, or I do something that reduces my risk. So I could get rid of the entire position. I could change the size of it. I could do something to hedge it, or I can even buy some puts on lower strike prices to hedge me if the market turns back. But the fact that the market was going up and the volume was not particularly high, and the market's so thin and spread out, that's an indication that the market could be getting ahead of itself on a day time frame basis. When you think on a little longer time, we are now at 2824.50. So we are well above the 2800 level. Being above the 2800 level that far, the odds are fairly low that we're not going back there anytime soon. So when you think about the bigger picture, not a day time frame, you know, it'll happen in a day time frame, but the market has looked below the 2800 level. There was no downside follow through, and just the opposite is true. We have some new buying coming into the market. Okay, how much time do we have left in H period?
5 minutes.
Okay, so you can see that, I mean, the day's progressing, the market's going higher. The odds are very good here that, you know, when you go back and look at a bar chart when today is over, more than likely you're going to see an excess low. And an excess low, it looks pretty meaningful. You say, wait a minute, it's unlikely that this market turns around and goes back down right away. Of course it could, but there's not high odds of that. When the market got rejected from below the 2800 level and rallied as far as it did today, the odds are pretty good that this market is going to continue higher and continue higher for some time. Now that's easy to say because I obviously know what the outcome was, and I know that's a true statement. But you can also be thinking that as you're trading and preparing your reports for the following session. One of the things, and can we turn it stop for just a second? One of the things that is so important is this daily preparation. And you've heard it before, you'll hear it again. When you come out of the day time frame, and remember, there was a lot going on today. It looked lower, traded higher, traded back lower, and it was a lot of volatility. We had one of those half-hour periods, we had about 8 or 9 handle range, and a lot of volatility. When you come out of that current day or out of a day like this, you can lose perspective of what's really going on. You can be too negative, too positive, whatever. The best thing to do at that point is go from the shortest time period, which you're trading on the day time frame, go to the longest period, which would be a monthly bar. You look at the monthly bar and get some perspective. Then you look at the weekly, then you look at the daily, then you come back down the profile. But you go from the shortest period when you're watching the daily profile trade, and as soon as the day is over and you're probably pretty narrowly focused on the market, you now want to step back. Step back, remove yourself, take a look and see what the market looks like on the other bar charts to get some idea if you see rejection or acceptance. So right now, we're not going to see much acceptance down below the 2800 level. All right, let's turn it back on. This market is exceptionally thin. If I were long in here, I would certainly take back all or some of my longs, because I don't think the market, if the market holds all of these single prints up here today, chances are pretty good we give them back later on in the next day or two. So the market's still one time framing higher. We do have a trend day, right? Because we've been one time framing from the low. One of the most important things, and one of the reasons among many that I wanted to go through and talk about today, is that so many times trend days are killers for people. They should be easy. On a trend day, you just go with the trend. So many traders, they just can't believe that. They keep wanting to short the market all day long. Market's going straight up. They may be mad at themselves for missing it in the morning, or they had a losing trade. And it's just amazing what happens to the trader. They get it in their head, well, price is too high, and they short this thing. And they get taken out of the short. Well, they wait. They're really mad now, so they wait, let it go higher, short it again. Let me just net this out very quickly. One of the worst trades you can do is fading trend days, meaning go against. If the trend day is up, meaning shorting it. It is absolutely a disastrous event. But traders can't, they find it so difficult. Oh boy, this trade from this market from the low must be up, what, 30 handles? Over 30 handles? And oh boy, I'm going to go short. And you keep thinking it can't go any higher. Well, it does. It goes until it's over. The worst trade you can ever make is fading a trend day. Well, everybody go back and they'll show me an example where they made money. I'll go back and let me see all your trades. And I'll go back all your trades on trend days, and I'll bet I'll find far more losers than winners. Okay, we've traded, we changed time periods again, getting very late in the session. The market remains very thin. There's no stopping this market at this point. One time framing continues. What we do find, another area where traders get caught, on trend days, the market usually stops one time framing at least once. And more often than not, that cessation of one time framing takes place late in the afternoon. What it does is it gives some of the short-term inventory, those traders, give them a chance to see the market come back into short-term balance, very short-term, but it allows inventories to be adjusted. Those that were too long get a chance to get out of the market. And those, if it's a trend day, what happens? Those traders that want out, they liquidate, they get out of some of their longs. And if the trend day is really good, as they get out of those longs and short and sell their positions, new money comes in, new fresh money with a much lower cost basis, a much higher cost basis comes in and replaces them. So we haven't seen that today, but we're getting late in the session, and I don't even remember if it happened this day, but I do know that very often you'll get a cessation of one time framing once during the day on a trend day. What happens, what is really an insult, is maybe traders that went short a couple times as the market was going up and lost money. And now as soon as the market starts to correct, for the one time it stops one time frame, they get all excited and they jump on board on the short side without understanding that the market allows some inventory rebalance or some of the weaker longs to come out so that the market can then go higher. One of the sayings we have, sometimes a market has to break before it can rally further. Sometimes it has to, it has to go lower to get some of the weak longs out or weak shorts out before we can go higher. So on this day, you've got a lot of longs in the market. Sometimes the market has to stop one time frame long enough to let some of those longs out of the market. They get replaced by stronger, newer money, and the market then continues higher. So we haven't stopped one time framing once today. J period looked above I. It's come back in. Now notice that the market is back into the range from the first. That is not a particularly strong sign. That should have been support. It wasn't, okay? So now it takes, to stop one time framing, you need 2 ticks in the opposite direction. K period only went a single tick below J period, so it has not stopped one time framing yet, although we did re-enter the range from the previous day, and that is usually not the strongest sign. Okay, so we keep watching, and my strongest sign, it just made me, it's more of an indication that the market needs to take a short-term rest. Okay, K period is still only a single tick below J, so we have not seen a cessation of one time framing. See how much trade's going on right around that very visible, well-recognized reference, which is the high from 8-1. That's markets. A lot of people are non-thinkers in the market. And a lot of times the non-thinkers use some very easy to follow indicator, such as the previous day's high or low, in order to, have some assessment of where the market's going. Still J period or K period still pushing down near the J period low. Still no cessation of one time framing. Okay, the market has now officially stopped one time framing. What I want you to feel in here is how emotionally some traders may feel, oh boy, I got to get short. I don't want to miss this trade. Oh, they've watched the market go up all day and now they're sure it's going down. And I learned this multiple times very hard way. I'd watch a trend day go up and boy, I couldn't wait for this to happen. I go short and all of a sudden, before you knew what happened, the market was back, taking out the highs and extending to the upside. I wasn't a very fast learner. I probably had to get burnt 10 or 20 times over several years before it dawned on me that there's information there. I'm just using it in the wrong manner. Okay, so one time frame has ceased at least one time. Jen, how much time is left in K period?
Only 3 minutes.
Okay, so we did stop one time framing once. We're just a little bit time left in K period. We'll go into L here very shortly. Okay, so the K period range was relatively narrow from the other ranges that we've seen. So relatively narrow. It did allow the market to come into short-term balance a little bit. L period so far is, pretty tight within the K period range. Now we're playing this at how many times regular speed?
10x speed.
Okay, 10 times the regular speed. Okay, Okay, so we've looked at least 2 ticks above the K period high. See the market got a little volatility. A little volatility. You had a sell-off in there. Being 10 times, it happened very quickly. Didn't happen that quickly if you're playing regular speed. But okay, so now you've stopped one time framing, twice. L period, looked above K period, then came back in and took out the K period low. So now this is an hour, K and L, so basically an hour once we get through L period, that the market is using this period to come into short-term balance. It is a very normal, natural thing. Markets was up strong all day long, and it just used this hour to come into short-term balance. Too many times you'll get all excited and you'll want to go short on this market on a trend day up. I mean, I can tell you, and particularly when you re-entered the previous day's range. Yeah, I'm not telling you anything I learned out of a textbook. I'm telling you things that I learned the hard way and at great expense. I would fight trend days, and it feels so good when you first put on the trade to fight a trend day. Boy, you think I did something. I took control. And it feels good for about 30 seconds. And then you feel just terrible. You've had the feeling, you've watched the market go up, you haven't been there, and all of a sudden it shows the cessation of one time framing, comes back in the previous day's range, and you hit that sell button and say, oh boy, I took charge. And that lasts about a minute or two, and then you realize that you feel far worse than you did before. I hope I'm not exaggerating, because I mean, I'm talking about things I really feel, I have felt, and a lot of you may not know what I'm talking about. And if you don't, that means you're probably a better trader than I am or was. So, but emotions are so important. Trading is understanding 2 sets of emotions, yours as well as those you are competing against. Both are very valuable pieces of information. You understand what the traders that you're competing against are doing, you will have a great advantage. You'll understand, you'll get a feeling, are they getting too long? Are they getting too short? And understand how they feel. Understand how you feel when you get too long or too short. That will help you have a better appreciation for those people you are competing against. And the more understanding you have of how they're feeling, the easier it is for you to compete. All right, so M period, we're getting late in the session, getting very late in the session. We stop one time framing for 2 periods. The market, as we get later in the day, the market's coming back up towards the high. Remember what I said? Very common on a trend day for the market to stop one time framing once, which it did in K and L period. Once that is up, it's over, and the inventory has had a chance to come into adjustment. The market then turns back towards the high. What we're talking about here is so much better taught from an immersion standpoint than it is from a linear standpoint. Immersion teaching, to me, is the realest, closest thing you can get to hands-on appreciation and understanding of what a market is doing. Now, it won't be yours until you're absolutely doing the trade yourself. But it's not somebody telling you, well, when these 2 lines cross, or some indicator, whether it's an RSI, what we've seen here is what really happens on the market. You're looking at real orders by real people coming into the marketplace. Okay, we went up, we made a new high. We're getting very late in the session. Following M period, we have a 15-minute runoff that gives you, an appreciation of what the, what the day is doing right at the end of the day. The market came out of balance. Now you're just getting some additional balancing going on. Remember, it's come from a long way. The high today looks like to be about 28, 29, almost call it 28, 30 handles. So, I mean, from the low to the high, we're over 30 handles today. That is a lot of range for the day. So we come into the high, okay, end period, the runoff period. Okay, we no longer have any excess on the high. Look at the excess on the low. Jen, can we go back down and look at the excess on the low? Single prints. Excess and balance are the two most important concepts you'll ever deal with. Additionally, the 2800 level, we said the market had been looking at that level. So don't trade in a vacuum. You be aware of those things. Now we go back up and let's compare the excess on the low to what do we have on the high. Okay, we have no excess on the high. The odds of the market ending right here are very low. Okay, so the market's just about to close. You've seen a trend day. It was really a very exciting trend day. You look below the 2800 level, you dealt with a gap, you saw the gap filled, you saw us come back into the previous day's range, you saw the market one time frame, you saw the market stop one time framing as advertised late in the session, allowing short-term inventory to come back into balance. And now, as the runoff period is coming to an end, you have no excess on the high coming into the previous session. So whether you liked today or not, whether you thought it was too strung out, or whether you thought it had, not enough volume, the chances are that it is not over. Additionally, the chances are that since it failed below the 2800 level, the odds are very good that this market is going to trade quite a bit higher. You come out of these days sometimes and you don't feel like it, think, boy, that was a terrible day. Or particularly if you made a short trade. If you made a long trade, you may feel much different about it. But also remember, you don't want to fight these trend days. All right, let's stop there. You've seen a trend day, and we'll take a look. I can tell you that the market on the following day gapped higher. And that is not inconsistent with the fact that we had no excess on the high of the second. You may think it was too strung out. You may think there wasn't enough volume to support the move, but you had no completion to the current auction. Completion comes in the form of excess. Excess is most easily recognized through single prints. All right, we'll be back with other days as we continue with the foundational course.